The day I crossed $200,000 in invested assets is the day I realized that almost everything I'd learned about personal finance up to that point had been preparing me for the wrong game. I'd been investing for about 12 or 13 years at that point. I had a system that worked: automatic transfers, index funds, a contribution rate creeping up every year. The first 100,000 had been a grind. The second 100,000 had been faster, but I still felt like I was the one doing all the work. The day I noticed the account had crossed 200,000, I sat down with a calculator. A historical 7% real return on 200,000 is about $14,000 a year. I was saving roughly $12,000 a year at the time. For the first time in my financial life, the money I already had was earning more for me than the money I was adding. That number stopped me, because what it meant was that the game I'd been playing for over a decade, the savings rate and discipline game, had quietly ended. A different game had started while I wasn't paying attention. This video is about that different game. 5 rules that change once your invested savings cross $200,000. Most people don't realize they've crossed this line, so they keep playing the old game with the wrong tools, and they leave a lot of progress on the table for years. I'm Tom. This channel is about real personal finance for normal people. No motivational fluff, no fantasy returns. Just what the math actually does over time. If that's what you want, hit subscribe. Quick framing before we get into the rules. Most personal finance content I see treats portfolio size as a continuous variable. The number goes up, that's it. The reality is that the rules of the game change in specific, identifiable ways at certain milestones. The first $100 a month is one milestone, which I covered in a different video. $200,000 invested is another, and it's a much more important one than people realize. Here are the 5 things that change. The first thing that changes is the structural math of your wealth. Up until about $200,000, you are the engine. The money in the account grows, but the growth in any given year is small relative to what you're contributing. The savings rate dominates the returns, and the discipline dominates the strategy. The math is essentially driven by your behavior, which is why every personal finance video aimed at people in this range talks about contribution discipline, automation, and habit. That's correct advice for people in that range. At 200,000, that relationship starts to flip. A historical 7% real return on 200,000 is roughly $14,000 a year. That's a little over $1,000 a month, generated by the portfolio itself with you doing nothing. For most people in the saving range that gets them to 200,000 in the first place, 14,000 a year of growth is in the same ballpark as their actual annual contribution. The portfolio is now doing work that's comparable in size to what you're doing. This sounds like a small distinction. It isn't. It changes what you should be paying attention to. Up to 200,000, every extra dollar you can push into the account is a significant lever. The decision of whether to contribute $400 a month or $600 a month moves your trajectory meaningfully. After 200,000, the same $100 a month decision still matters, but it's now competing with whether your asset allocation is right, whether you're going to panic sell in the next downturn, whether you're going to talk yourself into a clever strategy that costs you a few years of compounding. The leverage points have shifted. The game you've been playing is no longer the game that's going to determine your outcome. This is the math people are gesturing at when they say the first 100,000 is the hardest. The hardest part isn't the 100,000 itself. The hardest part is the discipline of saving through years where the compounding doesn't yet feel like much of anything. 200,000 is where the compounding starts to feel real. From here, the portfolio's own behavior becomes a significant force, and your job changes. The second thing that changes is what a normal market move actually costs you in dollars. When your portfolio is $20,000, A 30% drawdown was $6,000. Painful, but absorbable. You knew rationally that the recovery would come, and the dollar amount was small enough that you could ride out the year without losing sleep over it. The lesson you learned from the experience, which I talked about in my first 100 a month video, was cheap to acquire. When your portfolio is $200,000, a 30% drawdown is $60,000. That is real money. It's a year's salary for many people, watching itself dissolve over a few weeks. The S&P 500 dropped 34% in about 5 weeks during the COVID crash in early 2020. Someone with $200,000 invested at the February peak saw their account at $132,000 by late March. That experience is different in kind from the one you had at $20,000. The cognitive pressure is heavier. The temptation to do something is real. Here's the rule that comes out of this. You need to have decided in advance, calmly, before any drawdown begins, what you will do when one arrives. Because the moment you're in it, your judgment is going to be impaired by exactly the loss aversion that evolution wired into you. And the worst possible time to make a high-stakes decision is when your emotional bandwidth is being consumed by watching your wealth go red. What the pre-commitment looks like. You will not sell. The automatic contributions keep flowing if your paycheck keeps flowing. Rebalancing into the drawdown only happens with money you'd already planned to invest, not with emergency cash you suddenly decide to deploy. The account stays mostly closed during the drawdown, except for the planned rebalancing day. And the basic trust holds that the market has recovered from every previous drawdown in history given enough time, and that this time is not going to be the exception, regardless of what cable news is telling you. Write these down. Tape the list to the back of an office door if you have to. The point is to have a rule written in your sane state that your panic state has to argue against, because your panic state will argue against it. The drawdown, when it comes, will feel terminal. It will feel like this time is different. And every single previous generation of investors has felt exactly the same way during exactly the same kind of moment, and every single previous market has recovered. The third thing that changes is the volume and the sophistication of the pitches you start receiving. Once your portfolio crosses 200,000, you stop being a small fish for the financial services industry. You start getting ads from boutique advisory firms. You start getting cold calls from people who somehow have your number. A friend at a barbecue mentions an exciting alternative investment they want to bring you in on. You start seeing YouTube ads for actively managed funds, option strategies, real estate syndications, private credit feeders. The pitch underneath every one of these is some version of, now that you have real money, you should be doing real investing. That sentence is the most expensive sentence in personal finance. Here's why. The latest SPIVA scorecard, which is the industry standard for tracking active funds against benchmarks, found that about 90% of actively managed US large cap funds have underperformed the S&P 500 over the past 15 years. Not slightly underperformed by enough that, after fees, they delivered meaningfully less wealth to their investors. Those are the professionals. The retail investor numbers are worse. Morningstar's most recent Mind the Gap study, which tracks what the average dollar invested in funds actually earned, found that investors underperform the funds themselves by more than a percentage point per year, simply because of the timing of their buys and sells. That gap compounded over the decade to about 15% of the fund's total return, lost to bad timing alone. So when somebody at this stage tells you that the boring index fund approach is for amateurs and that real investors are supposed to be doing something more sophisticated, what they are actually selling you is the opportunity to underperform. The boring approach that got you to 200,000 is the same approach that gets you to 1 million. The temptation to tinker increases at exactly the moment when tinkering is most expensive, because you now have more wealth to lose to your own mistakes. A friend of mine, I'll call Brad, walked through this version cleanly. Brad got to 200,000 through pretty much the same approach I used. Index funds, automatic contributions, target date funds in his retirement accounts. He was in his late 30s when he crossed the line. Then, like a lot of people at that point, he started reading about real estate investing. He convinced himself that the smart move at his stage was to diversify into a rental property. In 2021, he pulled $50,000 out of his portfolio as the down payment and bought a single-family rental in an exurban market that had been climbing fast through the pandemic. The mortgage was around 3%. The property looked solid. The math on paper worked. Two things he hadn't fully accounted for. Mortgage rates climbed from 3% to over 7% in the next 18 months or so, which broke his refinancing math and started compressing comparable sale prices in his market. And his specific exurban market, the one that had been climbing fast, was one of the markets that corrected hardest when rates rose. By the time he sold the property in 2023 to stop the bleeding, between the price decline, the months of vacancy waiting for a tenant, a surprise repair on the HVAC system, and the listing costs, he had taken something close to $60,000 of total damage between the lost down payment and the operating drain during the months when the property wasn't earning. Meanwhile, the same $50,000 left in his index funds would have been up around $16,000 by then. The strategic detour cost him roughly $75,000 in net wealth versus the do-nothing alternative. Brad's not stupid. He's a careful, intelligent person who reads a lot about money. The pitch got to him because at his portfolio level, the pitch was designed to get to him. The lesson isn't that real estate is bad. The lesson is that at $200,000, the cost of being talked into something clever is much larger than it was at $20,000. And the pitches become specifically more sophisticated at appealing to your sense of being ready for the next level. The fourth thing that changes is which lever actually moves your wealth. In my first 100 a month video, I made the point that for someone just starting out, the dominant variable in their wealth trajectory is their contribution rate, not their investment selection or asset allocation. That's correct at small portfolio sizes. The math at $200,000 quietly inverts that advice. Here's why. At $10,000 saved, the asset allocation of that $10,000 barely matters, because what you're adding each month is large relative to what's already in the account. At $200,000 and growing, the math has flipped. Your existing portfolio is now large enough that what it does for you in any given year is on the order of what you're adding to it. The composition of the portfolio matters more than the marginal additions to it, by a wide margin. This is the moment to actually think about your asset allocation properly, instead of defaulting to whatever a target date fund decided for you. The honest, defensible default for most people at this stage is something like a 3-fund or 4-fund index portfolio. A broad US stock index, a broad international stock index, a bond index, and possibly a small REIT allocation. The weights depend on your time horizon and your honest tolerance for drawdowns. For most people in their 30s at this stage, that comes out to something like 75 to 90% in equities, split maybe 70-30 between US and international, with the remainder in bonds. For people in their 40s, the question becomes how much volatility you can tolerate without doing something destructive. But somewhere in the 70 to 85% equity range is a defensible default. The specific numbers matter less than the fact that you have made the decision actively and understand why, and that the portfolio is set up to behave the way you want it to during the kind of drawdown we talked about in Rule 2. The mistake at this stage isn't usually picking the wrong allocation. The mistake is not having actively decided. People drift along on whatever their 23-year-old self set up, or whatever the default option in their 401k was, and then in their early 40s they discover they're either way more aggressive than they want to be, or way too conservative to keep the portfolio growing the way they need it to. Both errors are expensive at this scale. The fifth and last thing that changes is what daily price action does to your psychology. When your portfolio was $20,000, a 1% move was $200. Most days you didn't notice and you didn't check. When your portfolio is $200,000, a 1% move is $2,000. On bad days, that's a real feeling loss. On good days, it feels like you've made money. Either way, it's a number large enough to occupy your attention, and that attention is exactly the thing you don't want being occupied by daily noise. The single biggest behavioral risk at this portfolio size is starting to check daily. Because once you check daily, the volatility of the daily numbers gets into your head. You see a bad day, you feel the loss, and your brain starts looking for things to do about it. The things to do are almost always worse for your long-term returns than the option of doing nothing. The behavioral finance research on this is pretty consistent. The Morningstar gap I mentioned earlier, the more than a percentage point a year that average investors lose to timing decisions, that gap is almost entirely a function of how often people interact with their accounts during periods of volatility. People who check their accounts twice a year capture nearly all of the fund's actual return. People who check daily capture significantly less. At $200,000 compounding over 20 years, that gap is worth more than $150,000 in foregone wealth. The rule is simple. Check quarterly at most. Set a calendar reminder for the first business day of January, April, July, and October. Open the account, take a look at the balance, do any rebalancing that's actually needed, and close the app. This sounds extreme. It feels extreme when you start doing it. Within about 6 months, you discover that you don't actually need the information you used to get from daily checking. The market does what the market does. Your account responds to it whether or not you watch. The watching adds nothing except emotional noise and the temptation to act on it. So here's what I told myself the day I noticed I'd crossed 200,000 and finally understood what was actually happening. The hard part is over. The hardest financial decision I will ever make is the one I made at 23 when I started auto-investing $100 a month. Every decision after that has been an incremental adjustment to the system I already had running. The portfolio is now large enough that it's pulling its own weight. My job from here is mostly to stay out of its way. Don't tinker, don't panic. The check-ins stay quarterly. And no clever pitches from people whose business is selling clever pitches to people in my position. What I had to internalize was that the second half of this project doesn't reward the same behaviors that the first half did. The first half rewarded grinding, discipline, raising the savings rate every year. The second half rewards patience, restraint, and the willingness to do nothing when your instincts are telling you to do something. Different muscle, different game. If you want me to walk through what doing nothing actually looks like as a strategy at this scale, I made a video on this channel called How to Let Your Money Rest and Grow that goes deeper into that side of it. Watch that next. Drop a comment with where you are right now. Whether you're working toward the first 100,000, past it but not yet at 200, or past 200 and starting to figure out the new game. I read every one. Hit subscribe. I'll see you in the next one.